RIUNIT Philippines Report Launch Webinar, exploring what's next for the Philippine economy and property markets, hosted by Roshan Matanuela, founder and CEO, Research Intelligence Unit, presented by Nirikshani Mendes, research economist, and Hashanran Mini, research economist, Research Intelligence Unit.
Hi, good afternoon, good evening, good morning. A big warm welcome to all of you. Today is the Philippines Report Launch webinar conducted by the RIUNIT, the Research Intelligence Unit, looking at the number of people joining us from all over the world: London, Dubai, Singapore, Philippines, of course, Manila, and other places, Sri Lanka, Bangladesh, Maldives. So a very, very warm welcome to all of you. So before we start, maybe many of you are not very familiar with the Research Intelligence Unit. So let me spend a few brief words on giving you a brief of the company and what we do and what we are about. I would say that the Research Intelligence Unit is a company specialized in emerging market economies. And whilst real estate is by no means the only sector that we cover, it is probably the most specialized of all the industries that we cover for our clients. So when we do a real estate report, we first of all look at the market. Is it feasible? So in the case of Philippines here, we have selected the Philippines for the first time. So in many ways, this is an inaugural report for us and is a very exciting time indeed. And once our investors have selected a country, a market, and maybe a sub-market within this country, then we would get into a series of feasibility studies before the launch of any project. So these would include things like a site or location, feasibility study, a design and product feasibility, and then many of our clients also do a marketing strategy, market feasibility, which all would plug into a financial feasibility. So a lot of study and a lot of research collection on the ground and secondary data as well. So the company is currently in about a dozen emerging economies, including now the Philippines, Sri Lanka, Bangladesh, Nepal, Maldives, and we're headquartered in London, and we also have an office in Australia. Right. Before I wrap up the profile on the company, I think it's appropriate to say that we have been around for 22 years. We're in the 23rd year of operation, and we have facilitated over $750 million in real estate investment into the emerging economies, primarily into Asia. If you were to draw a straight line from London to Melbourne, I would suggest that would be a nice way to see our geographic footprint in terms of the locations in the countries where we are. I hope that makes sense. Now, why the Philippines? Now, why are we looking at the Philippines at this moment in time? Let me say, first of all, every time someone says the Philippines, I think of an amazingly talented people from the Philippines through my own interactions. It's a very rich culture and amazing people and very warm and hospitable and extremely talented, wherever the Filipinos are to be found anywhere in the world. But that alone doesn't attract investors, as we all know. So the reason why we have chosen Philippines to launch in this webinar are several. Now, let me start with some of the findings from our research over the last 22 years in emerging markets. So a number of factors or variables have a very serious impact or very significant impact on demand for real estate. Many of these are perhaps obvious to many of you who are practitioners and academics in real estate. So obviously the most important one is a GDP growth rate. An economy, an emerging economy where GDP growth rates are strong, attract more investors because the prospects for future growth are seen to be positive. But this is by no means the end of the story. So a deeper look reveals that many variables, such as the growth of tourism, the significance of a diaspora community and remittances, infrastructure spending and development. As we all know, especially residential real estate follows infrastructural developments and infrastructure spending very closely. Developers watch out for new railway lines, new highways, new expressways, and other types of infrastructure spending. Also, what we have found, especially in emerging market economies, is the significance of special economic zones. And here again, we see that Philippines has been selected based on some very promising infrastructure spending. If you went to the conventional thinking, and if you went to the IMF with why we should look at Philippines, they would also say, institutional factors are important, property rights law, government policy, and demographic factors. True, these two are also important according to the research that point to these being of significant value as well. On top of that, we have the increasingly important role that the environment now plays. So in particular, flooding is the biggest natural disaster. Billions of dollars worth of damage are done through flooding. So these are going to have an increasingly important impact on future real estate investors as the sustainability, environment sustainability factors also will come into play. Finally, perhaps, the global situation. I don't know who's able to predict what's going to happen in the world next. It's a very tough job. The world is certainly characterized by vulnerability, uncertainty, and ambiguity. And it certainly doesn't make our jobs any easier these days to work out what's going to happen next, especially with unpredictable leaders around the world. But we try our best. So before I move on, I would suggest that we understand the difference between the factors that are important in an emerging economy as compared to factors that are crucial in developed economies. For example, interest rates in the context of a country like Philippines will be of less significance than they would if you were analyzing the markets in, say, Europe. So why the Philippines? In a nutshell, you have some $38 billion annum in remittances. We know this is very strong and it underpins a lot of real estate demand and underpins a consumption economy. Infrastructure, as I mentioned, critical. The Philippines has allocated 5.8% of GDP for infrastructure. Amazing, and obviously a fantastic stimulus, and something that the investors look at and impacts their sentiments. Another big one, tourism. 3.5 billion, I believe, in 2025, in terms of tourist revenue, 13.5 billion, which again is a very good number. And all of this amidst a GDP growth, I think, which averages above 5% over the last several years. So this brings me on to the format for today. What we have is the country report presented by research economists Hoshin and Nirwadda. They will start as soon as I finish. Then we will have a Q&A session where you guys will be able to send your questions. In fact, you can start sending your questions now. We can start looking at it. Feel free to write them in the Q&A box, and we will get to that towards the end, and we will try our best to keep the whole session to 1 hour. A word about the report. We cover the macroeconomy of the Philippines, and then move into the real estate sector. We cover residential real estate, commercial office, retail real estate, hotels, and then the overall outlook for investors. Let's also keep in mind that every year, an average of $75 billion are invested into emerging market economies in the real estate sector. According to the Morgan Stanley Index, investment into the emerging markets went up 20% last year, which is a hugely encouraging sign and the best performance since COVID for sure. So what we're looking at here is an opportunity for the Philippines in a family of emerging economies where you can tap into a total investment of some $1 trillion this year, of which we feel the emerging markets are going to get an increasing share of interest and indeed investment. So on that note, I'm going to hand over to Nirwadda to first of all walk you through the economy of the Philippines and then touch on the real estate sectors. And yes, please do send in all your questions and we'll get around to an interactive session after the initial report presentation. Thank you once again, and over to you, Nirwadda. Thank you.
Thank you, Mr. Roshan, and thank you for that wonderful introduction. So let me quickly set the context for today. Mr. Roshan has done a wonderful job there. So this webinar is based on our Philippines country report, as he has mentioned, and the report itself covers a few key areas. We will be starting off with the macroeconomic overview. Then we will be moving into the real estate market size, and then how the office market space works on, and then the hotel sector, retail sector, and the forward-looking outlook. So you can see that in our report, everything ties up together. So now just to be clear, today's presentation is a quick high-level walkthrough of these mentioned themes. So we will highlight the main trends and insights, but the deep analysis, data, and the details are in the full report. So if you are interested to know more, you are warmly welcome to purchase it through our website. And a quick note again, if you have any questions about our presentation or related to our report, you can put your questions into the chat box or the Q&A box. So with that, let's start where it all begins, the macroeconomic picture of the Philippines. We have selected this as the first set because that sets the foundation for everything else we are going to talk about today. Moving on, we are coming to the macroeconomic overview of Philippines. As Mr. Roshan has mentioned, the big picture of the Philippines economy, it's a consumption-led economy. We can see that a strong income buffer is there with the remittances, and the overseas income created real cushion in this economy. So you can see that it really keeps the local liquidity and the spending resilient in this economy. And on top of that, the country is in a long-term infrastructure push. So the growth is not only about the consumption. We can see that it's also into the capacity building. That's a positive sign. Moving towards, we can see that there is a very helpful base in this macroeconomic overview to the real estate because it supports the end user demand, investor confidence, and the long-term corridor development is happening. So towards the GDP and the demand drivers, we will be looking at GDP first. So if you look at the 2025 third quarter, the real GDP growth was around 4% year on year. That was actually a temporary slowdown. Why do I say so? The data itself explained it was driven by a 26% contraction in the public construction because the projects were paused and revalidated during this time. So you can say it's more of a governance and spending pause rather than calling it a structural collapse. So now what's important for the real estate sector is even when that happened, the economy was still held up by the services, which grew up by 5.5% during this period. And it's also the sector that contributes over 60% of GDP by 2025. I think in most of the countries, this is the scenario, like the service sector is providing a big help for the GDP. And this is really matters because the service-led economies usually support the urban jobs, increasing office demand, and the steady residential absorption. In terms of the inflation, this is a really good point for the property because the Philippines ended 2025 with 1.8% inflation in December. On average, it was around 1.7% for 2025. So basically, the economy is growing. That's clear. Without overheating. That's the main point that we have to consider here. So that means that which is supportive for the construction cost, affordability, and the longer term cap rate stability. Moving towards the interest rates or the forex as well as the external sector, you can see that the data highlights that the BSP policy rate, or else in the Philippines we call it as RRP, it went from 2% in the pandemic to a peak of 6.5% during this inflation spike. So financing conditions were tightened, but now we can see that the cycle is getting normalized. It's coming back. From an investor lens, easing and stabilizing rates usually improve what? The mortgage affordability, and it reduces the pressure on developers' financing cost. If we look at the forex and the external buffers, in terms of late 2025, the peso is referenced around 58.85 per USD. And the official reserves are about USD 111.3 billion. And that was able to cover 7.4 months of imports. That's really impressive. So that's a strong external stability signal, which is important for the foreign investors when they are looking at the currency risk. In terms of the external trade, yes, I admit that there is a deficit. But the data frames this as a capital import story. Because in the first half of 2025, the trade was accounted for USD 106.99 billion. And this deficit is tied to the imports of capital goods that is supporting to the long-term growth. So you know that is actually consistent with any kind of infrastructure heavy economy. Moving towards the tourism sector as well as the government debt, we have put those things together. So in terms of the tourism, there is a major real estate tailwind, especially for the hotels, retail sector, and to the mixed use. So tourist arrivals, it was hit around 5.9 million in 2024. And the tourism receipts were about USD 13.1 billion. I think Mr. Roshan also has mentioned it in the beginning. So these data notes that we are above the 2019 growth. So that tells us the demand is back and the spending environment is also slowly improving again. If I'm going to talk about the government debt, the total debt is around USD 297.6 billion, and the debt to GDP is referenced around 61% as of late 2025. The important thing to look here is the structure, because this is mostly domestic. The domestic debt is around 69%, while the external debt is around 31%. So you can see that it reduced the forex vulnerability. So yes, as I have previously mentioned, there is a debt. but the composition is relatively safer, so that the infrastructure direction remains supportive for the real estate corridors. Moving towards the real estate market. So with the macro base in your mind, I think now we are in a good position to shift towards the hot topic in our report, which is the real estate market. Moving towards the overall real estate market size, we will be looking at how it was in the last 5 years and what's the potential. So this slide is basically showing the overall market size trend. We can see that we have go from around USD 80 billion in 2019, and there is a slow dip in 2020 and a steady recovery through to USD 94.5 billion in 2025. So we are not just back. The specialty here is that we have moved above the pre-pandemic level. This is important because you cannot say that all around the world, every country was able to do that. Only few countries were able to recover or else come back to the pre-pandemic level. So, and the key part that you have to bear in your mind is the base case suggests that the sector can grow around 5 to 7% nominal per year. And that simply implies a potential market size of around USD 120 billion to 135 billion by 2030. So that's the big why now for the investors. This is a scaling market. This won't be a stagnated one. It wasn't and it won't be. Moving towards the supply and vacancy of apartments. So we will be looking at how the demand and the inventory. So this is important because this explains the current residential reality. Demand is improving, but inventory is still heavy. That is something that we have to bear in our mind. So the demand side activity reached 6,643 units. That's a clear pickup. On the supply side, there are new launches around 1,761 units, but the big number is the inventory. We can see that 82.8K available units around across 638 actively selling buildings, which is about 37 months of supply. So basically around 3 years of inventory is there. Now what's interesting is the split of it. Completed or as RFO or as ready for occupancy stock, it looks largely absorbed, around 95% sold. But pre-selling absorption is weaker in this economy, which is 62% are sold out. So buyers are more cautious about the forward commitments that they are going to make, and they prefer ready or near ready product. And in terms of the location, the unsold stock is concentrated. If you look at the Quezon City, Ortigas, Bay Area, Manila, Alaban, so these are the pressure points where the pricing and incentives are more negotiable if you are going to invest or buy. So in terms of the investment, this is a key market where the asset selection matters. You can still win in this market. You have the potential. But how are you going to win? You are going to win by buying the flight to quality. Always think about the best quality products to buy. And because, you can negotiate well, and especially in the high inventory submarkets in terms of this. Moving towards the rental yields by location, we can see that in 2025 third quarter, top prices were reported in the BGC, Makati. These are the most expensive areas. And then the annual trend, the whole market dipped slightly in this year. In the last year, 2025, Makati and Alaban, they took the biggest hit, which is minus 4%. The big winner was Taguig. We can say that it is the long-term king. It was growing since 2020. The big loser, I don't want to say though, the Bay Area and Pasay, they were crashing. So they have lost half of its value over the last 5 years. Moving towards the top residential projects and developers, I won't be taking much time on this. So you can see that in this slide, the short list of the high-end projects that are actually shaped in the luxury segment in the Philippines real estate. So the message that you have to take is, even with the overall inventory pressure, as I have mentioned, the best-in-class luxury product in prime location still attract buyers. So this is the flight to quality theme. It approves, it can be proved with this as well. So moving towards the office space market, now we are shifting towards the grade A office space, mainly Metro Manila plus the key provincial hubs like Cebu is interested in this area, in this office space market. So moving towards the office demand and vacancy. So here we are going to talk how the recovery versus oversupply story for the offices. You can see that leasing activity has clearly improved. So the demand is there. It's not dead, but the vacancy is still elevated. Total vacancy is around 3.2 million square meters with about 18% vacancy rate. And Metro Manila itself holds 2.7 million square meter of that vacant space. So what does this really mean for the investors? It means that office spaces are splitting. Modern, efficient, grade A assets in strong locations hold up better, while the older or the oversupplied submarkets need more incentives and the repositioning to be sold out. And moving towards the office lease rates by location, top markets are BGC. It is the most expensive, closely followed by the Makati. And then the mid-range ones are from Ortigas and the Bay Area. Most affordable ones are from Quezon City, and they offer the lowest entry point. And the retail highs, we can see that premium lifestyle and retail spaces like Megaworld, they can come on much higher rates. So basically, the rent levels are still clearly tiered by location and quality. And the best addresses remains the strongest even in the higher vacancy environment. And moving towards the top office projects and the developers. So I won't be taking your time again. If you would like to purchase the report, you will be getting all these data in our report. So the major office ecosystems and where the supply is concentrated is given in this slide. So if you are investing in offices, you want to align with three segments, which are, you have to think about the prime ecosystem, modern grade A efficiency, and the locations where demand engines like IT BPM sector, which actually prefer to expand and has the potential, right? So with that, I have come to an end of my part, and I would like to hand over the presentation to Hoshin. Thank you.
Thank you, Nirvada. It was a very good and interesting presentation. So colorful as well.
Thank you.
Love the theme. And myself and actually some members of the audience have sent in some questions. So we'll come back to you straight after we hear from Hoshin. Over to you.
Thank you.
Yeah. Thank you, Mr. Roshan and Nivada. So now we move into the hotel sector. So this is where the tourism recovery and spending really starts to show up in performance numbers. So moving on to the next, the chart in the left-hand side shows the tourist spending is back in a big way, right? So if you look at the international tourist expenditure was around 11.61 USD billions in 2019, and it has been through some fluctuations. However, it has rebounded in 2024 to around 12.18 USD billions, and it has somehow come to around 12.39 USD billions. So in this case, tourism expenditure is not just recovered, it is slightly above the 2019 base as well. Right. So the affordability point of Philippines also matters here. And if you look at the average daily rates of Philippines, it is around 102 USDs, which is competitive versus other peer countries such as Thailand, Vietnam, Cambodia. Right. Moving towards the occupancy and the supply. So it is significant to note that the Department of Tourism of Philippines and also the Philippines Hotel Owners Association, they are shooting for a globally competitive hotel industry, and they are targeting to reach around 456,000 room keys by 2028, according to their newly launched hospitality sector map. So based on this plan, the country has to catch up with the room gap around 120,000 by 2028 to enable this baseline scenario according to this development plan. So at present, the current room supply is at around 335,000 from a total of around 18,818 accommodation establishments across the country. So this is the demand and supply situation as of now. And also looking at the occupancy, so here we can see the occupancy is the strongest in the higher quality segments. So you can see in the upper scale and also in the luxury corridors, the occupancy has reached around 73%. For mid scale, it has eased to around 63%, right? So the occupancy is strongest, as I mentioned, in the higher quality segments. And also to make a quick note on the new room supply, if you take to 2025, it is around 3,000 new rooms that has entered into the market. So that also gives a signal about the market confidence or its growth potential as well. So the message here is premium segments, luxury segments are holding up well. But as new supply is coming, the location strategy and brand positioning also matters a lot, right? Moving on, here we can see some indicative room rates. We can see who is positioning where. And the brands such as Radisson, Grand West, Savoy, Hotel Manila, Alpha Duns, they are sitting at the high end of the pricing spectrum, while the other properties cluster lower. So what I would say here is the rate dispersion here tells us the market is not one single hotel market. It is clearly and definitely segmented. So the opportunity is strongest where you can align your brand, location, and demand drivers like the major tourism nodes, right? And moving on here, we can see some of the top hotel projects and developers. Once again, we are not taking too much of your time in here. So with that, I'm moving on to the retail sector, and we are looking at the tier 1 retail malls in Metro Manila and also the provinces. So moving on to the next, we can see in this particular map, it gives a geography-based view where the retail space is and how it is performing, right? So you can see the distribution of retail space by submarket, and the key message to get from here is mall ecosystems are strong, especially where population density and transport links support the footfall, right? So on vacancy side, it is also noted that the mall vacancy is improving from post-pandemic highs, right? There is a definite visible recovery curve where vacancy moderates again as the mobility and the spending normalize, right? And if you also look at the numbers, the pre-pandemic benchmark is around 9.7% of vacancy, and we have been through some fluctuations, and by the third quarter of 2025, the vacancy has eased down to 11.4%, which is impressive, right? So from a real estate investment lens, the Philippines retail story is still strong, linked to definitely foot traffic, tenant sales productivity, and also the mixed use integration as well, right? So moving on here, we can see some prices, and we can see a clear split between the Metro Manila, the capital, and the provincial asking price. And what we can see is the pricing power is, without a doubt, is still concentrated in prime metro formats. So in USD terms, the asking levels in Metro Manila is about 25 USDs to 31 USDs per square meter, and provincial proxies are far lower. And moving on here, we can once again see the top retail projects and developers. Last not least, we are now coming to the outlook of each of these segments, right? So first I would start with the residential segment. So I would say from the research that we have done, the residential apartment sector is still in a digesting first, right? So why I say like this is right now we have bit elevated inventory, but the outlook shows that the market gradually works through this stock before it becomes a cleaner seller's market again, right? So the estimated absorption improvement shows that by 2027, the inventory life will ease to around 28 months of supply, meaning that is the time that would take to clear out the existing supply given the absorption trend, right? So by 2030, this would come down to 24 months. So that is the outlook of the absorption trend for residential apartments. So in simple terms, what this means is in 2026 to 2027 window, it is still a buyer-friendly period, right? So developers remain more flexible with their promotion plans, payment terms, and pricing negotiations as well. But after 2028 onwards, the pricing power slowly improves, especially for flight to quality assets in prime ecosystems, right? So moving to the office spaces, this is a uneven normalization because hybrid work and past oversupply effects, they don't just disappear overnight. However, according to the forecast and the industry findings that we have come up with, from current vacancy around which is around 18%, we would expect this to ease down to around 15 to 16% by 2027 and also further tighten to 12 to 14% by 2030. So what to expect here is grade A office spaces, they have a strong ecosystem and they becomes more stable after 2027, right? And the demand is most defensible when there is strong tenant engines like IT BPM sector. So moving on to the hotels, this segment is one of the strongest outlook segments because the tourism spending has already recovered above the pre-pandemic. The projected ADR growth is around 4 to 6% actually per year. And in USD terms, the ADR is around 140 USDs as of now, and we expect this to rise up until 175 by 2030, right? So occupancy also expected to remain healthy, especially in upper upscale or luxury corridors, supported by higher value tourism and also improving MICE and corporate activity. So finally, let's talk about the retail sector outlook. And this is also projected to keep tightening as foot traffic normalizes and tenant sales improve. So the vacancy forecast is right now it is around 11.4% as of 2025. And we expect this to be tightened around 9 to 10% by the end of 2026. And also by 2030, we expect this to further tighten to up to 8 to 9%. And in terms of rent growth, it is also expected to be moderate but steady, around 3 to 5% annually in prime assets. And the key drivers is the shift into experiential formats like strong food and beverage exposures, entertainment, curated retail malls, and international brands as well. So, to wrap, actually, it can be said 2026 to 2027, it is the positioning window where residential still has some negotiation power, offices still have vacancy friction, but hotels and retail are already strengthening, right? So when it comes to 2028 and 2030, it is the normalization or growth window, we can say. So it is when the inventory clears, vacancy compresses, the ADR also rises, and also the tier one retail tightens further. So that is why overall the Philippines context looks beneficial for a real estate ventures in 2027 period onwards. So with that, we have come to the end of the summary presentation of the Philippines country report. So as we mentioned throughout the report also, if you want detailed explanations or information on these segments, it's available in our detailed country report, which is available in our official website. So it will be sent to your chat box also, the link that through which you can access the report directly. So with that, I think we can take some time to answer some of the questions that you have sent us. And thank you.
Hoshin, brilliant. Thank you so much for that presentation. Very insightful and lovely visuals as well. Now, I've got a question here. It's from someone in the audience for Hoshin. It's regarding the retail sector. And this is something which obviously is very interesting because if you remember with COVID and which gave a massive boost to e-commerce, people were spelling the end of retail malls and retailing as we know it, and how the future is going to be dominated by people ordering stuff and receiving it by drone, etc. But the data doesn't suggest that is the case in emerging markets in general and in Philippines as well. We're just looking at that. And people do seem to like the old school way of doing things, of going to the mall, a very human interaction, trying stuff on. So I noticed that Philippines is now caught up with pre-pandemic levels. So the question is, are malls still investable given the e-commerce? And what does the vacancy rate tell us about its investability? Over to you, Hoshin.
Yeah. Thank you. That's an interesting question, and thank you for the question. So yes, I would say it is still investable, and it is a emerging segment as well. If you look at the vacancy rates from the third quarter in 2025, it was around 11.4%, which is a growth from, it is around 13.1%, sorry, which is a growth from 11.4% in the first quarter of 2025. So there is the direction of growth is positive, the trend is inclining. So the pre-pandemic benchmark is also 9.7% of vacancy. So we are slowly reaching that as well. So we cannot say the e-commerce have actually killed the retail industry. So the vacancy rates in Philippines shows a different story, right? And also we can see a lot of international brands coming into Philippines, into the retail malls, like IKEA, Zara, and a lot of other international brands. So when these global brands also enter, so it means that they believe foot traffic is strong and the spending is recovering. So we can't say that the e-commerce is dying because of the technology. Traditional ways, they don't work. We cannot support that argument. But the e-commerce has emerged a separate market, I would say. So the malls that are modern, well located, and experience led retail malls, they are filling up easily, and also at having strong investor attraction as well.
Thank you. Now, I was just going to add my 2 cents worth, which actually was just to note that e-commerce has, in many ways, had an impact, whilst maybe not reducing foot traffic. It has shifted to more F&B vacancies, right? And larger food courts and entertainment, cinemas in malls and things like that. Probably as a reflection that some of that business, for example, apparel, has probably shifted to the online sector. All right, another question. This one's for Nirwadya. Why should we be comfortable investing in Philippines now, given recent GDP moderation? I guess the question is the GDP moderation a long-term concern, or is it due to short-term factors? Over to you, Nirwadya.
Thank you for the question. I think that sums up the whole presentation with that question. So you know that Q3 2025 GDP, it was slowed down to 4% year on year. I think that's why people are asking this question. So I should say, and even in the presentation I have mentioned, that was a temporary and policy driven. It wasn't demand-led one. So it was mainly caused by the 26% contraction in the public construction that was done by the government due to the project revalidation during this period. But you know that the services sector, it was growing during that time also, 5.5% percentage. And now, you know that the contribution from the service sector, it was 60% for the GDP. So you can say that overall, these things support the urban employment, housing demand, and the office absorption. Inflation is also very low. So you can say that the economy is growing without overheating. I think I have mentioned this before as well. So this simply indicates the growth without macro stress. So this is the best time then. I think I have answered your question.
Yes, I think you have. Because one has to always consider the nature of GDP growth.
Exactly.
It's very misleading to take 1 year or even 2 years, but we must look at this in terms of a growth cycle, I believe. Having
Exactly.
the entire globe reset in many ways, then we enter the new cycle, and the trends in international investment that we can see into emerging markets also represents that cyclical movement, right?
Exactly. I agree.
And indeed, also the travel numbers, the tourism now getting back to pre-pandemic levels and in many cases surpassing it.
Yeah.
Right. So that was an anonymous question. So don't worry. You can, we don't think it's something to be seriously concerned about. Okay, next we have a question from Jason Gerard Alonso. He wants to know about the vacancy rate of condominiums and hotels, since most of the condos now are quite not that robust. Okay. So is there a concern about the condominium vacancy rates? Are they high for the region? Is that a long-term concern? Who would like to take that one? Anyone?
So for hotels, actually, the vacancy rates are little bit recovered and is strong in the upper upscale segments and in the luxury corridors. But if you look at the mid-scale or like economy or budget hotels, the vacancy rates are still improving because of the seasonality and all. But for luxury and upper scale hotels, the vacancy is around vacancy is actually improving. The occupancy is around 73% on average in a year.
Okay. So what we can read from that is perhaps investor confidence in the long-term appeal of the industry and the sector. If we're getting investment, and the other fundamentals are good, then they obviously expect the vacancy rate to reduce over the coming period. But again, to answer the question that Jason has asked, I think you need to look at sub-markets, pockets of demand, and areas where design and project USPs play a very big role once you have a market that is very competitive. So Philippines is developing into a very sophisticated market. As GDP grows, I think these factors will play a greater role in, the success factors on a project-specific basis. I hope that answered the question. If not, please do drop a line. In addition to the QR code offer for you guys who are on this webinar, I think if you're a student and you can prove that you're a student, a further discount of 50% is available to support academia and learning in this industry. Right, a question from John Marco Cizon. May I ask regarding the e-certificate, if it's available for this webinar? Oh, sorry. Well, I don't know if you're giving certificates, but as I said, we are giving some special offers on the reports. And especially if you're a student, John, you can get this report for next to nothing. It's got a lot of valuable data. I'm sure you will find it useful. And we're always available to answer any further questions. Right, I've got another one for Hoshin. Which
Yeah.
infrastructure projects are going to move land values in the short to medium term? And where are they?
Yeah.
Something I would
Yeah.
like
Yeah.
to know more about.
Yes. Yeah. Thank you, Mr. Roshan. And thank you for that question. So there are few infrastructure projects that is going on in Philippines, and Philippines estate sector is actually driven by this infrastructure-led growth as well. So there is a big infrastructure project, the North-South Commuter Railway. So this is kind of a big rail train line, and it will be connecting cities like Clark and Calamba. So this should be partially running in 2027 as per the news and reports, and fully running by 2029 as well. So, and also there are Metro Manila subways coming, the MRT 7 project. This is right now around 83% is already been completed. And by 2027, this would be ready to operate. And also on the south side, we have the LRT 1, the caveat extension. So the phase 1 of this project is already been opened in 2024. The rest is still going on. So this will actually support new housing and township projects in that particular route. And the biggest project there is the Calix, which is a the expressway project, and full completion is expected to be finished by 2026. Right, this helps the Caveat Laguna corridor grow faster, and the travel time actually drops because of this. And mostly the most important one, I would say, the new Manila International Airport. And as per the news and the reports and from the research findings that we have got, the targeted opening will be around 2028, and this would be a massive game changer for Philippines as well. So these are some of the great infrastructure projects that would, elevate the value of the real estate sector in Philippines.
Got
Yeah,
it.
thank you.
Thank you. I think, yeah, you've highlighted some important projects there, which are going to have a huge, huge impact on the market. There's another question here from Jonathan Azeron. Hope I pronounced your name correctly. Compared to other countries within the region, where do you position the Philippines in real estate market? Is it attractive to property investors? So maybe if you allow me to jump into this one, what we found in research over the last 20 plus years is that for emerging markets, the determinants of real estate value are not the same as for developed markets, which are typically influenced to greatest extent by interest rates. In emerging markets like the Philippines, other factors like remittances can play a bigger role. We've seen times in emerging markets when rates have been extraordinarily high, but investment into residential property hasn't been disturbed, primarily because it comes through other channels, especially in a country where you have some $38 billion of remittances coming in annually. This can override other macroeconomic determinants. But again, to answer your question, there are a dozen things that investors look at. GDP growth is the obvious and probably the most important. Capital markets, institutional factors are still important because real estate is always a long-term investment. Investors will want to know the culture of property rights, property ownership, recourse to arbitration, international arbitration, things like that. So if you take a country like Maldives, it has a very high ranking because its record of investment arbitration is very, very high. And in almost every case, the damages are awarded to the foreign investor in international court. So these things also play a part. We'll have to give a deep dive into that on a case-by-case basis. I don't think time allows us to go into it, but to list a few other things, demography plays a very large role. Tourism is in many ways a cross-fertilizing factor for residential In some of the emerging markets, you find developers cater to tourism by accommodating long stay tourism. So apartments that developers build will target long stay tourists directly where your legal system allows foreigners to buy in, but also indirectly. So if you're a local investor and you know that tourism is expecting to boom in a particular area and the vacancy rate is going to be high, you would invest and rent out, and your rental yield is there. Conversely, during COVID, when the entire world's tourism sector was hit, as we know, we saw rental yields in these emerging market economies continue to slide. So rental yields in particular for residential apartments have a very strong relationship with tourism, not least because now as an apartment owner, you're effectively competing with hotels and service apartments. The platforms that are available to you now allow you to market your apartment directly to a tourist, just like a five-star hotel would. So technology has effectively been a game changer here, allowing apartment owners to compete in the tourism sector, which is kind of why we've included in real estate. 20 years ago, we would treat tourism separately, but because of where we are now, we consider tourism and leisure property to be a very integral part of real estate as a whole. Philippines is also doing very well, as I mentioned, in infrastructure. The government has allocated above 5% of GDP for new infrastructure. Fantastic for real estate. GDP strong, and as I said, tourism 13-14 billion in revenue. All are good signs. One thing which I might add from what I've seen in other markets is the impact that diaspora and non-Filipinos can have in your real estate market, especially residential. And here you have opportunity with appropriate government policy to be able to attract non-Filipinos to invest in your real estate, much the same way as countries like Thailand have successfully managed to do.
I think I would like to answer for Mr. Geraldine for a question, because I think this accompany with the first question that Hoshin has answered. In that particular question, he was asking about the condominium units as well. So let me step in, if you don't mind.
This is the other question, right?
Yes, I think in the first question.
Let me read out the question for the benefit of the audience.
Sure, thank you.
So before that, Jonathan, I hope your question regarding the competitiveness of the Philippines in relation to the regional peers was addressed adequately. If not, please do get in touch. So as you said, Nirwada, Geraldine wants to know the possible impact in the value of the condo units in view of the percentage of vacancy rates, right? In Manila, particularly. Okay,
Yes.
Please go for it.
Thank you. Thank you. So based on the reports from late 2025 to the projections for 2026, there is a high vacancy rates in Metro Manila. That is projected to peak around 26.5% by the second half of 2026. So it has created a buyer market, and it is characterized by the subdued capital appreciation and the downward pressure on the rental yields. So we can see that there is a critical oversupply, which was largely caused by the POGO, or as we call it as Philippines Offshore Gaming Operators ban, and there is a surge in the completed units order. As I have mentioned during my presentation as well, like there is a certain 37 months of supply. So means that property values are experiencing slow growth or stagnation. So particularly in areas with high vacancy, like the Bay Area. So there are certain segments which will be affecting to that, capital appreciation and the impact on the rental yields, impact on the investor. There are strategies that they are powering into. So if I talk about the impact on the investor or the owner strategies in terms of this, we can see that there is a shift in the market power. The market heavily favor the buyers and the renters, and it allows them to negotiate better deals. So such as lower prices as well as flexible payment terms they do have. And we can see further there is an increased competition also. There are 75,000 unsold or empty units across the metro, Manila. So owners must differentiate their units through the upgrades or amenities to attract more tenants. So you can see that there are certain segments, there are certain things that is impacting to that. Thank you.
Brilliant. Thank you, Nivedita. One last question, because I think time is up. And let's be brief. There is a question regarding how resilient is the Philippines to global economic, may I also add geopolitical and military shocks. We know that the Philippines isn't immune to geopolitical developments as they unfold. So any thoughts on that?
Okay, I think I would like to answer for that question. So as you have mentioned, I think in the beginning also you were telling that the world is with ambiguity and so many geopolitical tensions are coming up. So yes, it's very unpredictable. But when it comes to the Philippine economy, I should say that it is in a good position to absorb the external shocks. Why do I say so? Because in terms of economics, the resilience comes from three buffers. The first thing is the remittances and the overseas income. We all know that Philippines is in a really good position. They have a really good, the economy is cushioned well with the remittances and overseas income. So that stabilizes the consumption and liquidity of the economy. The first thing. Second thing is they are having a strong forex reserve, which is around USD 111.3 billion. And that is supportive to cover 7.4 months of imports. That's brilliant. I think most of the economies do not have that kind of a support. And also, in the presentation also, we have mentioned that mostly their debt is domestic. The domestic government debt, which is around 69%, external debt was around 31%. So that automatically reduces the currency risk. And you can see that with these three factors simply, it collectively reduces the downside risk for the long-term real estate investors. And this economy is really, they are having a really good tolerance for the external shocks. I think I have answered it.
Brilliant. Yeah, I mean, the 30% external debt is fantastic. And as you said, it seriously does cushion the Philippines from potential currency shocks. Yeah, I think that the Philippines is playing on a good pitch. So let's hope the story of positivity continues and global peace holds. In the meantime, we will get our management to review if we can issue a certificate. There's a lot of requests for an e-certificate of participation. I'm sure we can do something. So hold tight, guys. And before we say thank you and goodbye, just a reminder that if you scan this QR code, you will get, 50% discount on the report, I think, on the launch. And if you're a student, then a further 50% is available for you in our attempt to facilitate learning and advancement in real estate economics. Please do get in touch. We will look forward to a long journey in the Philippines with many of you who are here. Looking forward to meeting you in person soon and wish you all the best. Have a lovely evening. Thank you. Thank you to my panelists.
Thank
Thank
you.
Thank you
you.
to Team RIU. Thank you to everyone facilitating this webinar. And most of all, thank you to the audience and everyone who helped us to compile the report. Have a great day.